The seismic events of the last few weeks triggered by the Brexit vote means Britain is now very much on the cusp of significant change. Nobody quite knows what a future outside the EU will look like, but at least there is now certainty as to who will lead the country with confirmation of the new Prime Minister this week. Beyond the macroeconomic and political arenas, wealth managers serving high net worth clients are also on the cusp of notable change. Our research reveals groups must either lower pricing or improve engagement, and arguably they may need to do both. The situation is fueled by growing levels of discontent among high net worth investors, as revealed in a new core data report showing 74% of wealthy investors believe they are being overcharged. The cost conundrum is complicated by the emergence of a significant disconnect between investor expectations and the reality of returns in a low return environment. Wealth firms and financial advisors will need to bridge this expectation gap and do it quickly to mitigate fee dissatisfaction expanding further. The very real danger for both wealth management and financial advisors is that high levels of discontent create fertile conditions for automated advice models to thrive. Indeed, 66% of wealthy individuals we interviewed cited low fees as the main reason for potentially taking the automated advice route. In a low return and arguably volatile environment, keeping a lid on cost is clearly a key front in the battle for retaining and winning high net worth clients. And the challenge of preventing high net worths from defecting to the self-directed or lower cost advice route has been exacerbated by the UK's decision to break ties with the EU. UK advisors now have a real fight on their hands preventing high net worth clients from breaking ties with the advisor community and choosing a path of invest independence. A Brexit could well be followed by a Hexit, a high net worth exit. With other geopolitical factors also stirring in the toxic investment cauldron, Italian banks, the US presidential election, slowing Chinese growth and tensions in the South China Sea, it is imperative that wealth firms and advisors are able to demonstrate the extra value they provide to high net worth clients. Not doing so will have grave consequences. Our research suggests that if advisors were to only receive half of their current fees across their high net worth base, assuming average net assets of £2 million per high net worth client, a practice would forego more than £100,000 per annum. So the stakes are high, and while nearly half of high net worths end their relationship with advisors because of failure to deliver adequate investment results, performance is only part of the picture. Significant numbers of high net worth cite lack of communication and advisor failure to understand savings and retirement goals as reasons for ending a relationship. Furthermore, high net worths want portfolio strategies that help them manage risk and insulate portfolios from volatile markets. This desire for protection will no doubt strengthen in the wake of the vote to leave the EU. Overall, high net worth satisfaction is not purely linked to performance or cost. Advisors and wealth managers will need to raise the bar when it comes to service, and those developing robust strategies formed around diversification, risk management and long-term financial planning will be best placed to respond to the challenges brought about by recent decisions affecting the UK and its role in the world and subsequent impact on markets.